Today on Fear and Greed, new inflation figures show any future rate cut is a long time away. The superannuation industry hits $4 trillion and a major breakthrough in peace negotiations in the Middle East. Plus, Gerry Harvey warns on the economy, and we will tell you about a delivery person who hid $132 million US from his employer. It's quite the story. Welcome to Fear and Greed, daily business news for people who make their own decisions. It is Thursday, the 28th of November, 2024. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael. Great story.
Oh, it's a cracker. It's coming up a bit later on. The main story, though, this morning, Sean, underlying inflation in Australia remains stubbornly high. It is well above the Reserve Bank's preferred level, meaning rate cuts are off the agenda, at least kind of for now, for the time being.
Right, so the trimmed mean inflation, the Reserve Bank's preferred rate, rose last month, not fell, rose from 3.2% to 3.5% in October. Price pressures are across a broad range of consumer goods and services, at least they were last month. That's the bad news. The headline inflation is actually low, 2.1% lower than expected. It reflects energy rebates federally and in some states, but it actually artificially lowers the real state of price rises. When those rebates end, headline inflation will jump back much closer to underlying inflation. Underlying inflation, of course, is what the Reserve Bank looks at. Households are bearing the brunt of these price rises. Rents were up sharply over the past year due to tightness in the market. Fruit and veg prices were also much higher. Underlying inflation has now been above the 2 to 3% preferred target range for 3 years. Why? Well, supply constraints are a big part of that. But also there's this persistent demand from the post-pandemic spending, taking a long time to get out of the market. There's also the strong labour market that is keeping pressure on prices.
Can I just ask you quickly, Sean, about underlying inflation and kind of why those two figures are so far apart? What underlying inflation does in terms of what it strips out and why that's a more accurate measure of kind of where we are at?
So there are a bunch of prices which are really volatile. Petrol, energy are great examples. They go up and down. And if you wanted to always include those in your economic forecasts and kind of economic policy making, then, 1 month you'd be thinking, got to cut rates. Next month you think you've got to lift rates. So they try and take out the really volatile stuff and only look at the stuff that is very core to what people are spending their money on. And in the case of the energy rebates, which the federal government announced, also some states like Queensland, they're actually giving rebates as well. That's considered not core. I mean, that's just sort of in addition, it's part of the volatile aspect of it. So the Reserve Bank doesn't look at that.
Okay. So when you then look at the economic cycle then, it's looking increasingly likely that it's not going to marry up with the political cycle, at least if you're Prime Minister Anthony Albanese and trying to figure out when the election needs to be.
Very, very true. The election is due by the middle of May next year. Unlikely to be any interest rate cuts between now and then. I'm sure that Anthony Albanese and the Labor Party would have loved to have seen a rate cut before the next election. The Reserve Bank has said it wants 2 quarters of lower inflation before moving on rates. Rates are at 12-year highs. We know that. Also, analysis in recent days by Deloitte Access Economics has forecast a $149 billion budget deficit over the next 4 years and what they call off-budget deficits of another $87 billion. So that's close to $230 billion on budget, off budget over the next 4 years. Now, these off-budget things are stuff like forgiving HECS debt, so you don't carry it on the balance sheet, but it is a real cost. When you have big budget deficits, that's not necessarily good for a government wanting to get re-elected. Also, they keep interest rates relatively higher than they would have been otherwise. Then, Michael, there's the Trump factor. When he takes office in early January, there could be a surge in inflationary pressures globally if he slaps tariffs on imports into the US. Many economists, including those at National Australia Bank and Westpac, are now forecasting the next rate move, presumably downwards, to be the middle of next year, probably after the election. As you said, the economic and political cycles are not lining up for Anthony Albanese.
No, not looking too good. Now, staying in the world of economics, the value of housing construction, Sean, hit a 3-year high in the September quarter in some good news for the struggling sector.
That's right. The value of residential housing jumped nearly 2% to $23.4 billion. Haven't seen that level of residential housing construction in about 3 years. We last saw those sort of numbers when the government was making pandemic payments, and that was supporting the sector. There was also a jump in construction engineering. It shows a boom in federal and state infrastructure spending. On an annual basis, building activity has been concentrated in the non-residential sector. Think infrastructure, whereas dwelling construction, new homes, has been flat, even though more houses are needed. It suggests the economic growth rate for the September quarter will come in the low ones. Now, there's still a fair bit to feed into that number. We get it later, or we'll get it in a week's time or so, the September quarter GDP. A bunch of figures still to go in that, but it suggests the economy is expanding at about 1.5%.
And finally, the local share market pushed back above 8,400 points yesterday. Did you say 8,400 or 8,400? I don't know if
I'm an 8,400 person.
All right,
totally.
All right. Well, we'll stick with that. It's hard, isn't it? When I was thinking about this yesterday, kind of when you go from, say, print, as you did, into audio, suddenly you've got to get used to a whole kind of different way of operating. And suddenly you're dealing with pronunciations in podcast world. And goodness me, it's tough.
The hardest one for me, which you taught me, is that audio is in the present tense and print is in the past tense.
Yeah.
Unless you're doing a feature, then in print it's in the present tense. But generally on news, it's past tense, audio is present tense. So I'm forever mixing my tenses up because I'm so used to past tense, but trying to do present tense.
You would think we are nearly 5 years now into Fear and Greed. These
slow learner, Michael, slow learner.
I think we're all slow learners. We are gradually adjusting to this whole new world of podcasting. Back to markets, though. 8,400 points yesterday.
Yes, the S&P ASX 200 closed at 8,407 points, up 0.6%. Consumer discretionary stocks led the way, although all 11 sub-indices were higher. Commonwealth Bank had lost ground on Tuesday. Yesterday, it jumped more than 1.5%. Fortescue Metals Group, Goodman, Telstra, Aristocrat Leisure, they all ended up more than 1%. The laggards were or amongst the large caps at least, BHP, Rio Tinto, Woodside and Macquarie. In the midst of AGM season, City Chic Collective, try and say that 3 times really fast. You're going to get yourself into trouble.
Okay.
Yesterday, I'm going to try it.
I was like, you paused and I'm like, do I actually need to do this? It does feel like I'm actually going to swear. There are children listening to this podcast.
So you're going to try it?
City Chic Collective, City Chic Collective, City Chic Collective. I think I'm fine.
Ooh, well done. Yeah. Well, its share price fell more than 25% yesterday after the retailer provided a trading update. NRW Holdings held an AGM. It's a resources and infrastructure contract services group. It recorded a first strike against executive payments. And HMC Capital rallied 2% after the fund manager upgraded its earnings outlook.
All right, Sean, we've got plenty to come. We are talking superannuation, we're talking lithium and travel stocks and how an employee hit $132 million US. So much more to cover. We'll be back in a moment with the rest of the day's business news. Sean, the pot of gold that is superannuation in Australia has climbed above $4 trillion for the first time. It just keeps on hitting milestones, doesn't it?
It sure does. The Australian Prudential Regulation Authority said total assets rose by 3.7% in the September quarter to $4.1 trillion. So why has it jumped so high? Well, remember the superannuation guarantee jumped from 11% to 11.5% on July 1. That certainly helped. Also, strong market returns. Both the ASX and Wall Street are close to record levels or at record levels. Hence, you're seeing some benefits on the return side of things. The self-managed super fund sector now accounts for over $1 trillion of super money. About 25%. Massive. For the quarter, net inflows were $191 billion. Outflows were $120 billion. A lot of pressure on the industry, though, on the back of links with the union movement, how they actually spend their money, particularly around marketing and performance, of course. But it's a sector that just keeps growing thanks to that mandated super guarantee. Mind you, it's still well below the value of the housing sector. That one sits at about $11 trillion.
Sean, Harvey Norman held its AGM yesterday and Chair Gerry Harvey said Australia is heading into a great big black hole of government debt. God, Gerry Harvey has a way with words, doesn't he?
He sure does. The veteran retailer said Australia will be in a much worse position in 5 years' time, according to a report in The Australian. He said, we can't keep going as we are with rising costs for health NDIS, aged care and social services. He doesn't think interest rates will be significantly lower for another 12 months or so. Now, overall, the Australian economy is doing okay. He said same-store sales from July to October were up 1.25%, or 1.4% to be exact. He batted away suggestions that online retailing was a threat. Harvey Norman are particularly strong in large format home and lifestyle stores in communities which they said have supportive economies, strategic regional planning and efficient transport and logistics systems. Harvey Norman's share price closed up 3% yesterday. It's up about 18% for the year.
Rare earths company Lynas yesterday warned of ongoing volatility in commodity markets at its AGM, though its share price closed up just over 1%.
So Lynas is from Western Australia, a mine from Western Australia. It's the biggest rare earths producer outside China. It's a bit different to the lithium companies in that, rare earths is obviously different to lithium, but it has seen a lot of volatility in prices. Now, in the lithium sector, we've seen a lot of lower prices and they're struggling. At Lynas's AGM yesterday, the chair said that market volatility was contingent on what happens in China. There have been big drops in rare earths used in products like air conditioning units and aircraft engines. But the big one is the slowdown in electric vehicle sales. That's hit prices, not as bad as the lithium stocks, but certainly has hurt rare earth producers.
Sean, Web Travel, which less than 2 months ago was part of Webjet, made a $52.5 million profit for the 6 months to the end of September, and the news sent its share price up 13%, the best on the day for the top 100 stocks.
Now, 2 months ago, Web Travel demerged from Webjet. Web Travel is WebBeds is their main brand. It's a B2B business. The Webjet business now is a B2C business to consumer business. The WebBeds business is going really well. Stop looking at me like that, Michael. I'm getting my webs and beds mixed up all over the place.
It sounds like you're talking about like Spider-Man and where Spider-Man would sleep. You're like Web-Beds, Webjet, Web. I'm like, okay, all right, let's go.
Oh, dear.
It's as bad as you and trying to get through City Chic Collective.
That's it.
Yeah.
That's it. The WebBeds business is going well. Bookings are up 22% to 4.3 million. That's for the 6 months to the end of September. Growth is coming across different regions. They've upgraded the full year result as well. They've also announced a $150 million share buyback. Hence, the share price jumped 13% yesterday.
New South Wales just managed to escape blackouts yesterday after Sydney recorded its hottest November day since 2020.
In the middle of the day, Premier Chris Minns called on people to turn off pool pumps, dishwashers and air conditioners. He wanted as little household use as possible between 3 p.m. and 8 p.m. as temps hit the high 30s across the city. A surge in consumption alongside outages at 4 units along the East Coast means supply was very, very tight. The Australian Energy Market Operator said there was insufficient reserves in terms of generation across the day. Now, the AEMO, the operator, ended up stepping in and using emergency powers to force industry to keep demand stable, which helps with supply, and hopefully reduce demand if possible. It's more about keeping demand stable than it is actually cutting demand in that instance.
Okay, turning to international news now, and Israeli and Lebanese leaders have accepted a US brokered ceasefire deal, raising hopes, Sean, of an end to the year-long hostilities between Israel's forces and Hezbollah.
It came into effect at 4 a.m. Israel time. It's about lunchtime yesterday, Australian time. It occurred after it was approved by Israel's security cabinet. It needed also to be approved by Lebanon's caretaker government. US President Joe Biden said the deal was designed to be a permanent cessation of hostilities. Let's hope so. Israeli Defense Forces will gradually withdraw from Lebanon over a period of 60 days and be replaced by the Lebanese army. Hezbollah, the Lebanese militant group, will be banned from rebuilding its infrastructure in southern parts of that country. Australia's Foreign Affairs Minister Penny Wong welcomed the announcement, saying she hopes it's a catalyst for a broader ceasefire.
The news of the Hezbollah ceasefire helped international markets, didn't it?
Sure did. Wall Street hit a new high. The S&P 500 managed for the 52nd time this year to peak. Oil prices also eased back. Also worth a mention, in the US, the minutes of the Federal Reserve Board meeting were released. They show that officials were divided about how many more rate cuts are needed. That news pared back expectations of another rate cut in the world's biggest economy.
When you were talking on Monday on Fear and Greed the Week Ahead to Stephen Koukoulas, our resident economist, you were discussing the upcoming, at that stage, meeting of the Reserve Bank of New Zealand and the potential for additional rate cuts there. And well, yesterday, the Reserve Bank of New Zealand cut its benchmark interest rate by 50 basis points. That's another big cut, pushing the rate below Australia's cash rate.
So we're very comparable to New Zealand, our cash rates. It is now at 4.25%. We're at 4.35%. The Reserve Bank of New Zealand has been aggressively cutting rates since August amid a deterioration in the economy. Mind you, they were coming off a much higher point than our local rates. It's the third consecutive rate cut from the central bank over there. Australia is now well and truly on the outer when it comes to rate cuts. Think US, UK, Euro, Canada, New Zealand. They're all heading down. We ain't.
Finally, Sean, it is time to talk about this. This is really quite a remarkable story. US retailer Macy's has delayed the release of quarterly results after it revealed that an employee had hidden, but not stolen, there's an important distinction there, hidden but not stolen, at least $132 million of expenses related to customer deliveries over the past 3 years.
This is just odd. A lone employee who had responsibility for small package delivery expense accounting had, and I quote, intentionally made erroneous accounting accrual entries, end quote, to hide between $132 million and $154 million of cumulative expenses between late 2024 and November. So 3 years, basically. Macy's owns its namesake chain of department stores, along with upmarket Bloomingdale's and the Blue Mercury cosmetics chain. Hasn't had a good time of it, with its share price down 20% this year. Now, according to the FT, the Financial Times, Macy's didn't disclose the name or alleged motives of the employee involved in hiding the delivery expenses, but said the person had left the company. Really? What a surprise. The alleged amount concealed was a fraction of the $4.36 billion in delivery expenses that the company recognised during the period. Now, I'm totally speculating, but one thing that Macy's has been pushing is its ability to reduce delivery costs. And so analysts have quite liked the fact that Macy's have been really tight on delivery costs. Well, I think we know why. Up to about $230 million Aussie. 150 US, not accounted for.
Oh, it is just an extraordinary story, that one.
Yeah.
Anyway, up next, Sean, in the Fear and Greed playlist is the Property Pendulum, brought to you by Domain and Fear and Greed. And today we are talking about trends in property, trends in houses specifically, and the things that you need to have in your house if you want to kind of secure the best price, and the things that you should steer clear of as well, things that are either kind of just old or that are just too darn niche that no one is going to want to buy that place. So anyway, we discuss all of this in the Property Pendulum. It is coming up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you, Sean.
Thank you, Michael.
It is Thursday, the 28th of November, 2024. Make sure you're following the podcast and please join us online on LinkedIn, Instagram, Facebook, TikTok, and X. I'm Michael Thompson and that was Fear and Greed. Have a great day.